In my experience, I have noticed 6 major reasons that has negatively affected my clients' cash flow to the point where they actually went out of business and had to go work for someone else's business. Within a lot of businesses, I have seen so many businesses where they allow their customers to pay them whenever, and this affected their days sale outstanding, which is the first driver of your cash flow. Your days sales outstanding is the number of days it takes to collect from your customers. This drives your cash flow because the longer it takes for you to collect from your customers or your clients, the longer your business is without cash. To top this, you already have incurred expenses to service this particular customer or client, which means you are out of even more cash. You want this number to be lower rather than higher so that you will have access to cash sooner rather than later. And make sure you keep in mind that if this number is too low, you could risk losing out on having business due to having a strict policy. You need to determine within your business how long it takes your customers to actually pay you. Then make adjustments so that you can reduce this time frame, like shorten the terms or offer early payment discounts. Now, because I work with industries like retail, restaurants, and e-commerce, many of them were not tracking their inventory, which caused them to not know what products the business was actually selling out of. Therefore, they were purchasing products that their business did not need, and this caused them to overstock on unnecessary inventory. So basically, they were spending cash to let it sit. This affected their days inventory outstanding, which is your second driver of your cash flow. Your days inventory outstanding is the number of days it takes for you to sell through your inventory on average. So if your business sells products, you typically have inventory that you need to purchase and keep track of. In your business, you want this number to be lower rather than higher so that you can have access to cash sooner rather than later. Now remember, if this number is too low, you could risk losing out on business due to not having enough or the right inventory on hand. You need to determine how long it takes for you to sell through your inventory. Then try and find ways to reduce this number if it is high so that you can maximize your cash flow, like having a sale on any old items or overstocked inventory. So I had an HVAC client to actually go and purchase expensive equipment to do a job before they even got the contract to do the job. This expensive equipment was just sitting there for months, tying up all their cash flow because the cash could have went into something else to make more money for the business. This ties into your third driver of your cash flow, the sale or purchase of assets. An asset is something that your business owns and uses to make money. Assets within your business could be your vehicles, furniture, or buildings. As a business owner, you will need to buy assets and sometimes you will need to sell them. When you sell assets, it will increase your cash flow since you are getting money in exchange for your asset. On the other hand, if you purchase assets, it will decrease your cash flow since you need money to make the purchase. This drives your cash flow because when an asset is sold, cash flow will increase. As an entrepreneur, you need to write down what assets you own and think about your plans to purchase additional assets within your business. Consider selling assets if you need additional money and only purchase assets if you will get a return on your investment. By me working firsthand with entrepreneurs, I recognized that one of the big things that affected their cash flow was the low payment terms from their suppliers. This was a problem because they had to pay the supplier within so many days. So we got them to extend the days so that they could hold on to their cash a little bit longer. This affected their days payable outstanding, which is the fourth driver of your cash flow. This is the number of days it takes for you to pay your suppliers. When you buy things from vendors, sometimes you can purchase them on credit. This drives cash flow because the longer you take to pay your suppliers, your cash flow increases because you're holding on to your cash longer. Now you want this number to be higher rather than lower so that you can have access to cash longer. But keep in mind that suppliers are also your business partners and they would like to get paid in a timely manner as well. Not to mention that many suppliers often provide discounts to you for paying early. Now, within your business, you need to determine how long it takes for you to pay your suppliers, then negotiate payment terms to benefit both sides. But also remember to take advantage of early payoff discounts. Being an entrepreneur is so hard. There's always a new problem that you need to solve within your business, and it's always rooted to how can I make more money so that I can grow my business. But trust me, I know it's hard because of the many hats that you wear within your business every single day. I've helped countless business owners to solve this very problem with what I call profit, cash flow, and revenue drivers. These three key drivers are major to make your business move. This is truly the cheat code to making more money within your business. And if you see this working for you, schedule a call with me today by clicking the link below, within the description, or the comments. See you there. Debt. This is where a lot of businesses get caught up at. I have seen so many businesses get loans just to make payroll, not understanding that this is what keeps them in the hole even longer. You know the saying, they were robbing Peter to pay Paul. And let me just add, eventually Peter ran out of money. This is what bankrupts so many businesses. This is your fifth driver of your cash flow, using or paying down debt. This driver refers to any money you get from taking on debt, like loans. Eventually, you will need to pay down debt by doing things like making loan payments. Acquiring more debt will increase your cash flow because it makes more money available to your business. Now, paying down debt will decrease your cash flow because you will need to use the money from the business to make those payments. Using or paying down debt drives your cash flow because when you buy things using debt, you are not using cash, which improves cash flow. Now, as an action step, you need to determine how much debt you have and make plans to pay down the debt based on your goals, and only use debt to purchase something that will have a return on investment, basically an asset. One of the biggest issues I come across in most businesses is the fact that they are working 60+ hours a week and they can't even afford to pay themselves for the time that they actually worked within the business. This puts a financial strain on them, which causes them to lose their business because the business is not providing what it needs for the owner, you, to stay in business. This is what we call your owner investments or distributions. This is the last driver of your cash flow. Owner's investments is the money that you put into your business, which is called owner's equity. And owner's distributions is the money that you take out of the business. This is also called owner draws. When you invest money into your business, your cash flow increases, and when you take money out of the business, your cash flow decreases. This drives cash flow because the more investments you make into the business, the more your cash flow will improve. The point of the business is to provide a return for its owners in the form of owner distributions, which would lower your cash flow. You need to determine how much you are paying yourself and how much you are investing into the business. Create a plan to reduce your investment and increase your take-home pay. When you understand these drivers, you will improve your business tremendously. If you found value in this video, click the link above to learn more. From Everlife Accounting Group, my name is Karina, and thank you for tuning in to another episode of Financial Sense.